So basically, if you look at something like, just look at Tesla, for example. So they have I don't know, like a 30. I think the market cap is about 30 billion now. They have a 4 billion revenue run rate. They're losing about 400 million a year. And you can argue that a business like Airbnb or Uber is a capital light business. It's a tech business. Tesla is a manufacturing operation, with its manufacturing in one of the relatively higher um labor cost areas of the planet. And if they want to grow, they have some very, very significant capex. And so one should argue that one could argue that an Airbnb or something, which is capex light, deserves a richer valuation than a Tesla, which would, if they try to increase from 50,000 cars a year to 200,000 cars a year, for example, it would be a massive, massive, I mean, tens of billions in capex to get there. So uh, so even if they made an 8% profit, the PE would be over 100, and the best car companies make about 7%. So just to give you a sense, and then just to see how the money is moving from old economy to new economy. We have General Motors, which has actually a market cap, if you take out their cash, at a little less than Tesla. And Tesla makes, like I said, about 50,000, actually less than 50,000 cars a year. Uh, GM has nearly 10% of the global auto market, making about 9 or 10 million cars a year. So it's a rounding error for GM in terms of what Tesla makes. And they are the number one car company in the US and China. I mean, one in 5.5 cars sold in the US is a GM car, and similarly in China, they're number one, and they make over 10 billion in cash flow that's heading to 12 or 13 billion. Aggressively buying back stock, NOLs shielding most income, and people get excited about Tesla for the electric car. GM's got the Chevy Bolt coming out next year. It has a 200-mile range, pure electric, $30,000, and Tesla would not have a car equivalent to this till at least 2018. So GM's actually 2 years ahead on this, but because it has the name General Motors, nobody cares. And so you just see this kind of huge divergence in uh, in these valuations between kind of old and new economy. And you can also see it when you look at something like Netflix and Micron Technology. So this is a quote I took from David Einhorn's second quarter letter to partners without talking to David. So I hope he doesn't object. But he says our long-term outlook is that sometime in the next few years, Micron Technology, currently valued at 20 billion, with 3.7 billion in trailing net income, will be worth more than Netflix, currently valued at 40 billion, with 240 million of trailing net income. And of course, Netflix now is at 44 billion, and Micron is at like 15 billion. And if you ask Reed Hastings, the CEO of Netflix, about the stock price, his answer is, to me, he does not understand why Netflix stock is trading where it's trading. And the second thing to understand about Netflix is, while they have a little bit of their own content, more than 99% of what they're pumping through is other people's content. And other people's content is subject to inflation and subject to all sorts of other factors, because content is king. So Netflix has, even if you grant them that they have the pipe, what goes through the pipe has to be paid for by them to these content owners, who aren't exactly, I mean, you've seen that even in the cable business, the content owners versus the pipe owners, you constantly have this struggle. And so when Netflix is charging $8 to me to come into my living room with unlimited content, and they have to on the back end pay for that content, um, you know it's not a business model where you can say out of the $8, $7 is profit. That's just not the economics. And of course you've got all the technology costs and all the bandwidth costs where uh, some of the internet service providers are complaining about the the bandwidth and so on and the usage. Um, so again, Netflix is a fantastic business, extremely well run business. All of us love it. We get a lot of value out of it, but none of that means that the stock is going to be a winner. And another way to think about this is to invert, is to use Charlie Munger's inversion logic. Charlie Munger says you can solve many problems by inversion. So if you invert, so let's take something like Amazon, which I love. Probably spend too much money every month on Amazon, but Amazon has a market cap of I think 320 or 330 billion or something today. So if you are an investor today in Amazon, uh, it would mean that you're expecting that market cap to go up from today, because otherwise, why else would you put money into Amazon unless you were expecting robust growth from year out? And let's say if you were an investor with uh, somewhat modest uh, expectations of, let's say, maybe 15% or 20% a year, if you owned Amazon. Well, if you had a 15% expectation, then what your expectation would be that every 5 years the stock would double. And so over the next 20 years or something, Amazon would need to be 600 to about 2.4 trillion, 600 million after 5 years. No, actually more than that. 1.2 trillion after 10 years, 2.4 trillion after 20 years. Yeah, so it'd be about 5 trillion in 20 years. And if you think about the entire wealth of the planet, so first of all, the entire US stock market cap, all stocks, including Amazon, today is about 20 trillion. And so you're expecting that the rest of the pie would not grow so much, and the one company would be, I don't know, 10 or 20% of the US economy. And global wealth currently is close to about 100 trillion. And again, look at the percentage versus um global wealth. And global wealth is not going to grow from 100 trillion at 15 or 20%. It might grow at 1 or 2% a year or something. So when you do the math, the law of large numbers kicks in. And so count me as a skeptic on the 5 trillion valuation of Amazon in 20 years. So inversion is a good way to solve uh, some of these issues. And then we have this chart which shows the number of public companies, the PE over 100. And in 2000, we had over 100 of them, and now we have about 80 of them. This is that whole Nifty 50 of 2015, where most of those 80 companies are these, Amazon type high flyers. And anytime you've gotten high up there, you've seen that you've kind of come back down, and that may be another data point to uh, to look at. And so, on March 10th, 2000, which is the day the Nasdaq peaked, Berkshire Hathaway hit a multi-year low of 41,000. Its price was cut in half from 1998. And in fact, what was happening is that exactly that. The money was going from people selling Berkshire to buying all these different new economy stocks. And of course, I started Pabrai funds in '99, and we didn't have any of the high flyers in our name. And we did very well actually in the first year of the funds, including past the bubble being burst. We were up 70% because we were buying these companies that were very cheap because no one was interested, and such. And when the bubble burst, we really had no impact on what Pabrai Funds was doing.